Are you late to the game? Do your investment choices in your portfolio today make sense for the environment that we're in? Or are you still basing your choices off of what you know from the past? Find out today what investment choices probably don't make sense for your portfolio today and what would be more efficient for you going forward. Hello and welcome back to Consider This Program. I'm your host, Jamie Burton.
And I'm Grant Soliven.
So happy to have you, Grant.
So happy to be here, Jamie.
It is Super Bowl weekend. We are so excited, even though my team is not in the Super Bowl this year.
Absolutely. We're excited to see what happens with the Bengals and Rams this weekend for the Super Bowl. Really, it's hard, rooting for – you really got to root for both teams, Jamie, even though it's not our teams in particular. I mean, honestly, who knows the next time either one of these teams will be back in a Super Bowl. But realistically, it's going to be a fun game, fun match. And I think the way you started the program, are we late to the game, not just in the Super Bowl? I mean, honestly, I went to grocery shopping last night, and there was hardly any food in the aisles to grab. So hopefully not late to the snack game on your Super Bowl weekend, but also some of the stuff going into investments.
Yes. So what we want to talk about today is, are you late on your investments? Do you have in your portfolio what makes sense for today, or are you still making decisions based on what you know in your past? One of the big things that we want to talk about today is mutual funds. This was the most common thing that people would purchase to invest in for their portfolios, because that used to be what made the most sense. It was how you could buy one thing and get the diversification that you need, and that was really the only option that you had. But Grant, why is that no longer the most efficient financial choice for you?
100%. So just like we talk about the tax code always changing, Jamie, the investment realm is always changing. It's always being modified. I mean, the way you and I were taught at Purdue in our certified financial planning studies was, how mutual funds came to be, why they were so important, how brokers died, right? The 2000s was kind of the last day of brokers as mutual funds began to take off. And mutual funds still, believe it or not, are some of the largest vehicles that hold wealth. But exchange-traded funds became this little thing, and they're getting a lot of mainstream headline views. They're getting a lot of discussion just because of how efficient they are. Now, here's what's sad. Mutual funds are sold by a lot of companies. They still make a lot of companies a lot of money, and they're not going away anytime soon. And unfortunately, a lot of 401k plans, Jamie, they still only offer mutual funds. Very few 401k plans do we see have even an indexed fund, let alone exchange-traded fund, an ETF. And so it's just it's hard to break that mindset when all you know, especially in your largest investment account, your 401k, is still mutual funds. But hopefully we educate enough individuals that when they have control, or maybe when their 401k plan offers exchange-traded funds, they'll go to those leaner, meaner, more, I guess I would say, efficient investment alternatives.
And you're talking about exchange-traded funds. How are those different than mutual funds?
100%. So, just if you take a step back and look at pop the hood open and look under a mutual fund. Really what's going on is you have an investment manager that sits up top, or a team of investment managers, and their duty is to produce gain in that essentially bucket under the parameters they've been given. So, example, you may have a mutual fund that's only job is to capture American-based large cap growth companies, right? A couple companies come to mind. Apple, which I have to say on the recording that we own Apple. Tesla, it's their job is to chase the big growth names and to get a return, right? I mean, so they're going to be inside that mutual fund, those owners, those managers selling, buying, diversifying the asset classes amongst the parameters they're given. But unfortunately, what that does is it creates a lot of expense and costs that is hard to quantify. I mean, you're given this huge prospectus, Jamie, that's about as thick as an Encyclopedia Britannica, and you have to be a JD or an attorney to understand and to read it. And there's a lot of just hidden cost that goes into it. And unfortunately, also, there's a lot of hidden tax ramifications that come with a mutual fund. And so they're really complex vehicles that made sense, like you said back in the day. But an exchange-traded fund, much leaner. Essentially, it's a basket of those exact same holdings, no money manager or very few of them, and they're essentially saying, here's what you're going to get. Take it or leave it. You don't want it, that's fine. But it's a much leaner, more efficient, tax-efficient vehicle for the investor.
And it's so funny because what we see with exchange-traded funds is that the number one holder are mutual funds, because the mutual fund managers have now seen how efficient it is to hold exchange traded funds and get the diversification that they need without having to go and purchase individual stocks or other mutual funds, other ways to get diversification for a much cheaper price. So here you are purchasing these mutual funds, paying a money manager to manage that mutual fund when they're just going and purchasing the exchange traded fund that you could purchase on your own. So it's become a game where it's no longer the efficient thing to do to buy a mutual fund, but that's hard to know if you haven't kept up with today with what's new, if you're still going based off of what you have learned from the past. So that's why you have to keep on top of your game when you are looking at the investments inside of your portfolio.
100%.
Yeah. So what can you explain to me what investment overlap is inside of mutual
huge,
funds?
Jamie. So going back to Jamie's point, everyone that's kind of watching and listening to the show, it's really hard to be an investment manager. And I'm not going to try to make excuses for everyone that manages money, but it's no one can time the market. No one's a perfect stock picker. And so oftentimes, these individual fund managers that run these mutual funds, their job is to create growth. And when you see overlap is when, let's say you're in a 401k plan, right? And you're buying a growth and income mutual fund, right? And that's going to be kind of your middle ground, balanced, you would say, investment alternative. And then at the same time, you're buying like a Vanguard, S&P 500 growth mutual fund as well. Well, unfortunately, you think you're diversified because you have this S&P 500 Vanguard fund, and Vanguard I'm just using as a name. It could be any company's, S&P 500 fund or growth fund. And you have this growth in income, but what you don't realize is when you look under the hood, sometimes they're owning the exact same investment. They're owning the exact same single stock to get the growth. They're owning the exact same ETF basket to get growth. And unfortunately, the average investor has 11 to 13 different mutual funds thinking they're diversified. And when you really analyze each one of them, they're owning the same exact investments in each one of the mutual funds. And unfortunately, their thought of diversification just got wiped away because now they're over-leveraged in single holdings that they didn't even realize they were in.
Yeah, and that can be so painful. These people, going in thinking that, they have it figured out. They've got this diversification. They're safe in their investments, and then come to find out there's one company that can make a bad move, and it can be really detrimental to their portfolio. So that's why it's so important that we need to take a step back and look at what makes sense for today. Another thing that we see when people get closer to retirement is that they think, okay, I'm getting close to retirement. I need my assets to be more safe. So I am going to put the majority of my funds into bonds. Is that still what makes the most sense in our environment today?
Jamie, I think it's fun doing these shows together because you and I went to the same university, Purdue University, boiler up, hammer down. And, in our CFP studies, they essentially told us in class, I remember sitting there like, hey, and it's easy to make money as a financial advisor, 60% equities, 40% bonds. The bonds on a 30-year bull market, it's, we're going to be great. Interest rates won't go up. How does that happen? And today, when we look at that environment, if you were to come in my class, I think back in 2006 and 2007 in the investment class and tell me what was going on today, I wouldn't even know how to comprehend what you were saying because we were just ingrained in our studies that this was the way. And so, unfortunately, just to put it in perspective, back in, I think it was 1999, Jamie, is that the right time when you could do 100% bonds and have a 7.5% yield or interest rate, and your risk, the risk breakdown was very, very minimal. Today, in order to get that same 7.5%, your bond holding would be less than 5%. So what that means is the rest of the 95% of your portfolio you have today has to be made up of equities and other investment alternatives to get the same result back from 1999. That's how fast things change. And so you're right, Jamie, putting everything in fixed income may not be the best strategy depending on the situation.
And you really have to take a step back and look at what situation you're in and determine how much risk you are willing to take to determine what you can invest in to get the return that you really need to get to be able to draw income out and live off of it and not run out of your money. It's really a big juggling game, and it's a hard thing to do on your own. It's really why you should reach out to somebody who does this every day, whether it be you want to be your own fiduciary, if you want us to be your fiduciary for you. This is something that we deal with daily. We deal with this with all of the families that we take care of, figuring out our investment team, figuring out what makes sense to invest in to get a good return without taking too much risk, so our families have this money that they can live off of and be able to leave to their loved ones in the end. So
100%.
Yeah.
And so, Jamie, I do have one last thing.
Yeah.
I think you and Joe actually did a wonderful a deeper dive on this topic, and I think what the resource is, if you're looking for it on our website, it's Our Mutual Funds Making You Poor. I mean, you and Joe did that. It was a very phenomenal segment. So if you're looking more for that, go to our website and find that.
Mm-hmm. Yeah, absolutely. And our website is yourlifeafterwork.com. Go there. You can go there to sign up for a next steps meeting. That will send an email over to Brittany in our office, and she will reach out to you. Or you can give us a call at 800-928-4001. Brittany will get you set up with a meeting with one of our advisors. In that meeting, we're going to talk about what is best for you to do today, what is best for you to do in the future, and what Financial Enhancement Group can do for you if we decide to partner together. Please reach out to us at 800-928-4001. And also go to our website, yourlifeafterwork.com. Sign up for our Market Carver, where we talk more in depth about what we see going on in the market today.